Okay, now it's going. Okay, well, welcome. My name is Vanda Crossley, and I have with me Karen.newman. We're going to talk to you about the 10 steps to home ownership. A little bit about me. I'm an educator, been an educator for the past 15 years in health information technology. So, in getting laid off, I embarked on the role of a realtor, and I've been a realtor now for the past 3 years. I've been an investor with my husband for the past 20 years, so that's kind of how we got into real estate. I live here in Houston, Texas, from Chicago by way of Dayton, Ohio. Have a 11-year-old granddaughter that lives with me, an 81-year-old mother-in-law that lives with me. Been married for 37 years, have 4 children. So I committed to what I start off doing. So Karen is a native Houstonian, and she's been in the mortgage industry for 25 years. So all of your adult life, Karen, you've been doing
Pretty much. Yeah, I started really young, 10 years old.
Uh-huh.
Imagine that, child prodigy.
Yes. And she specializes in affordable home ownership and first time buyers. And Karen and I met because we were at a certification for Neighborhood Works. And that was for education for first time home buyers. And we just kind of clicked. And we definitely believe in educating people on how they can purchase a home, because a lot of people feel that it's just out of their reach. And that's not true. So, some of the benefits of being a homeowner is passive income. You can charge rent and you can become a landlord if you don't want to live in the home. That's one of the things you can do with it, which is how we got started. You have appreciation in home values and not making any more land out there. So, what's here on earth now is all you can get. And people have gotten really rich on just purchasing some land, holding on to it, and then later on somebody buys it and they're a multi-millionaire. Boy, I wish I was a Cinco Ranch. Wish I knew the person that owns Cinco Ranch. It
I
goes
know. Imagine. I know.
Imagine. I know. From cows to now it's a big subdivision.
I mean, it's just unbelievable. Yeah.
It can also provide some stability. So when rents go up, you don't have to worry about not making no more money, but now they're going up on my rent. You can do with the house whatever you want to. You can paint the walls purple or gold or whatever you want. Red, blue. You could put the sports team on there. And if you're an apartment, you can't do that, or they're going to charge you later on.
Exactly.
About that. And then, of course, you can leave a legacy for your family. Leave them something other than bills.
Yes.
So, transitioning to renting to ownership is a significant milestone and it's challenging. So, we're here to help you get some of that knowledge so you learn how to do it yourself. So, these are some of the steps to home ownership that Karen is going to go over. Schedule your mortgage planning session with a loan officer, such as Karen. Receive loan approval, home search. You would do that with a realtor, such as myself. The formal loan application and product selection, and she's going to talk to us about the difference in the pre-approval and the application and the actually getting it approved. Processing and underwriter's review, the final loan approval, closing, funding, close of escrow, and confirmation of recordings. And a lot of this terminology could be new, so we're here to break it down for you. So, Karen, who are the key players in the home buying process?
Well, of course, first and foremost, that would be us. You have your real estate professional who is going to give you full instructions and explain to you all the ins and outs of identifying or finding that forever home or that dream home or starter home, wherever you are in the process. And then, of course, you have your mortgage lender. And I always, encourage my clients, especially first-time home buyers, is that, sometimes in the process of selecting those individuals, it's a very important step. You have to get people that, first of all, you're going to trust. You feel, you have a certain comfort level with, because you're going to be sharing information with those individuals that most people don't share with their closest family members. I mean, I don't know, I mean, I love my family, but I mean, they don't know details about my income and,
Right.
my, how, my work, my employment history and bank accounts and things like that. And through this process, we get close and very intimate. And so,
You find out
you
about all of that stuff.
absolutely, we get down to the nitty gritty. So selecting the right people for that process is just vitally important. Especially, I find many times, because throughout the course of this process, oftentimes, when you introduce one thing, then it creates another thing, or it opens up another question that has to be answered or addressed. And you have to trust that the person who is giving you those instructions and requesting that information is doing it for all the right reasons. And if you don't have that comfort level with that person, and sometimes it can cause you to be resistant to want to provide those personal details about your financial history or your employment background, and it can slow down your process. It can even it can keep you from completing the process. If you don't have that trust, that comfort level where you're, willing to be cooperative. Sometimes buyers, will, we have situations, I have situations I'm dealing with now where people are like, well, why do I have to I'm giving you this? Why do I have to give you that? Well, because it's that's going to satisfy the condition when it gets to underwriting. And you have to trust me enough and trust my experience and expertise that I'm going to guide you in the right direction. I'm not going to ask you for something that I don't need, or I'm not going to ask you to do something that is not necessary. And
Right.
so it's vitally important.
So from a realtor's point of view, there are two realtors involved in the home buying process. You have the listing agent, who's hired by the seller. They're the ones who market the property. And then if you work with me as a buyer's agent, I'm hired by the home buyer. And so there are two sides to the transaction. So I would represent the home buyer, and my services are free. You don't pay me, I get paid from the seller. So that's something that a lot of people think, that they have to pay their realtor to get
Exactly.
started, and that's not true.
Mm-hmm.
So if you're a listing agent, you agree to pay a buyer's agent a percentage of the proceeds for the commission. So just wanted to make sure that was clear. And then the mortgage lending, your services are not paid up front, but they're paid within the closing documents. And so that's how you get paid. So the difference in pre-qualification and pre-approval, can you explain that?
Yes, ma'am. And that is one of the, typically when we start the process, that is one of the first questions that most people want to know is, okay, I need to get a pre-approval. Well, most lenders these days, I mean, everything pretty much that we do, we're living in a virtual society. Everything is digital, and it's getting it's evolving even more as we speak. Okay. And so industry-wide, we have access to certain automated underwriting software that is going to take the characteristics of your application, and it's going to assess that information based on details that we, as your lender and loan officer, input into that system. So when you complete an application, number one, what you're doing is you're giving us consent usually to communicate with you digitally and electronically, deliver documents to you electronically. And then you're also giving us consent to pull credit, which we have to have in order to complete the assessment. And then, most loan officers, if they're diligent, and they want to make certain that they're not sending you out on a wild goose chase just to later find out that there's some type of issue that, may create a problem and you're getting approval. We like to look at financials. We're going to ask for your pay stubs, your bank statements, even your ID, because we want to know that when we run that automated underwriting analysis, the loan decision that we get is going to be an accurate decision. And most lenders, once that automated underwriting system has evaluated your application and you have that loan decision, what the underwriter does is they actually validate that automated or AUS approval is what we call it. So the pre-qualification in itself is like the first part of that. You submit your application to the loan officer. They're going to pull your credit. They're going to look at the details of the documents you provide, your pay stubs, your W-2s, your tax returns, your bank statements. They may have questions about some information that appears on your credit report. And what we do is we're going to tweak that application that you submitted, because oftentimes, sometimes information, for example, I personally like to perform income calculations. A lot of people, for various reasons, I guess it's not something that we think about on a daily basis or whatever, but you'd be surprised at the number of people that really don't know how much money they make per month. And so we have to look at those pay stubs and kind of, if it's an hourly employee or if you're paid salary, if you get overtime, if there are bonuses. There are certain ways that we have to treat that income, just simply because you may be receiving it now. If there isn't a history of your receiving that income, then that makes a difference. So when we ask for all these things, it's because we need it in order to get an accurate representation of what your income really is. And so once we do that, we fill in any blanks or ask any questions that, with the documentation that may not be clear. And then we're going to get a result. And once we get that result, that's when your conditional pre-qualification is issued. And that is generally what you will normally use for your property search, because at that point, even though you have submitted an application with the lender, the things that actually, what actually triggers a formal application where you move forward with full disclosures and things like that, for compliance purposes and RESPA and TRID and all those other government regulated issues that we have to deal with in our industry, is an actual property address. And at that point, most people don't have a property. You're just looking to start your search. Typically, the entire process, lending process, from the time that the loan officer gets an application with a contract, the processor actually verifies employment and they do what they need to do in order to present the file to underwriting. That can take several weeks. And most people, if you're, especially in this market, you're not going to want to wait until 30 days in order to be able to get started. And if you provided your lender with all of the details that they ask for up front, there's really no reason for you to do that. Okay. The pre-approval does take it a step further, in that if you wanted a pre-approval, and some lenders do it, provide that as a courtesy. A lot of them that I have worked for, once again, they will, once you are actually under contract, that is when you actually have a formal application. It is fully processed. All of the information is verified, and then it goes before an underwriter.
So
and
you
the
can still
underwriter
get,
actually reviews that information that we have put together, and they determine, okay, based on the automated underwriting findings and the documentation that you have provided, we have a valid approval. And that's still, even at that point, even though it's considered, it's still conditional. Okay,
you can still
because
get
understand,
denied at
until we
that
get to
point.
that closing table, if anything changes,
Right.
then okay, we may have to go back to the drawing board.
Yeah, you can lose a deal because you changed jobs recently.
Absolutely. Absolutely. You can change jobs. Oftentimes people don't understand as we go through the process, you may open up a new account. You could have a negative item that reports to the bureaus. Once you are under contract and the lender begins the formal process, you have a formal application at that point, and we move forward. There are alerts that we get if for any reason there is a change in status in your credit report, even though that credit report that we have is good for a certain period of time, typically 90 to 120 days. If you get a credit inquiry, like if you apply for something, apply for a loan, whatever it may be, if any new information hits your bureau, any one of the 3 bureaus, we're going to be notified. And depending on what that is, it can change the whole trajectory of where we're going with that approval that we had yesterday can be invalid today if it changes, and it changes in a negative way.
So that's why it's important for realtors to put in that addendum for lending approval.
Right.
20 to 30
Exactly.
days so that you can get your earnest money back in case
If
we go
something
through
comes
all of
up.
this and you don't get approved, even though you have a pre-approval letter.
Exactly. Right.
It's just no guarantee. I always say,
There's
don't
no guarantee.
count your money till the money's in the bank.
Exactly. And that's what a lot of people, they get concerned. They say, well, I want a pre-approval. And I'm like, well, it's all conditional, because if there are any changes in most lenders, any formal letter of approval that they give to you, whether it's a conditional pre-qualification or if it's going to all say conditional, and that's what that means.
Okay.
If something changes, then none of this is valid and we have to start over.
So I had a client that was conditional approved with one lender. She went to a builder's lender and they said, no, we cannot approve you. She's like, well, okay, I'll go with my regular lender. But her lender made her pay certain bills off before closing, which if she had probably done that before, she would have gotten approved with the other person. But
maybe
it was conditional on her paying certain things off. And luckily she had the money and she could do it. But everybody don't have an extra $10,000, $20,000 on top of closing costs.
And once again, Vanda, that goes back to step 1 in choosing the people that you want, in picking your team, your real estate agent and your loan officer. And this is not by any means to throw, try to throw shade on anyone in my industry or anyone in particular, but not all lenders are created equal.
Yeah, I have said that many times.
They're not all the same. You need to do your research. Even I've been a seasoned loan officer. There have been instances where you get busy, you may miss something. I mean, we're human beings. We're not superhuman. We're not machines. Things can happen. But the difference between a seasoned loan officer and someone who has been in the industry, let's say a short period of time. And when I say a short period of time in this industry, and I never will forget it, I had a longtime real estate friend of mine who has known me the entire 25 years I've been in the business, to tell me when we first met, and when we met, I think I had only been in maybe about 2 or 3 years. And she told me, she said, oh, it's going to take you at least 10 years before you figure out what you're doing.
10.
And I was saying the same thing you said. I'm like, oh, she just doesn't know me. But I was on the phone. I'm like, okay, whatever. But as time went by, many times that neck jerk that I was giving her at the time, like, I had to take it. I had to take it back because there's no two, just like there's no two credit reports that are exactly the same. You will not ever have two files that are exactly the same. You learn from different scenarios and it helps you along the way. But understand, when it comes to getting in those difficult situations, like I mentioned before, where, okay, let's just say, you're multitasking, you miss something or whatever, that's where the skill set comes in. That's where your experience comes in, is learning how to fix those little things that pop up or those little things that you miss.
Okay.
And that takes time.
I use the analogy of loan officers like restaurants. Like, you can't go to every restaurant and get every meal, even though they all serve food.
Right.
Exactly. Certain restaurants you go to for certain things. So we need to know a little bit more about you and your situation.
Right.
To know which restaurant to send you to.
Which restaurant to go to. If that restaurant specializes in seafood and you're looking for pizza, right. Well, they may have some pizza, but it may not be as good as the seafood.
You don't go to a Mexican restaurant and order pizza.
Absolutely. Absolutely. Point taken.
My husband, because he did that.
Absolutely.
So Karen, what are some of the do's and don'ts in the loan process? You mentioned a few of them, like if you're getting ready to get a house and you got your pre-approval letter, we know you can go and shop for a house up to $225,000.
Right.
And then you go out with me, I take you to look at these homes, and it may take a week or two to find the perfect one. What are some do's and don'ts?
Well, I mean, first thing, I once again, education and preparation is key before you even get to that step. Before you even pick up the phone to entertain the process, the first thing you need to know as a consumer, because for most people, as we've heard over and over and over again, this is going to be one of the largest purchases that you can make in your lifetime. So preparation is key. First of all, you need to develop a budget before you even get to the lender and realtor selection. You need to have a handle on where you stand as far as your credit is concerned, how much you can comfortably afford as far as a mortgage payment, and then you need to evaluate your assets. Okay, because that's what the lender is going to look at. That's what is going to determine which direction that real estate agent is going to be able to move with your case. Now, once you've identified those things, you've started the process, you've been pre-qualified, you don't want to make any significant changes in your situation or your circumstances. Obviously life happens. There's some things that may be out of our control, but changing employment, even making large deposits to your accounts, that can jeopardize an approval, or because obviously everything has to be documented. We have to have a paper trail for everything that happens from the point from day one up until we get to the closing table. Okay.
How far back do you go with that paper trail?
Well, in most cases, we're going to want the most recent 2 months bank statements. Require 30, the most recent 30 days pay stubs. Now, obviously, tax returns, W-2s, those things are not likely to change during the process, but you would be surprised if anything changes as it pertains to your income or credit, then it can jeopardize your approval. You don't want to close accounts. You don't want to open new accounts. You don't want to go out and make large purchases that can change your monthly payment or credit scores or things like that. As I said before, if there are any significant changes that occur during the process as it pertains to your credit, we're going to get an alert. We're going to, and so that can come into question. And in some cases, like I said, what you don't want to do is wait until after you've put down earnest money on a property, you've paid for an appraisal, you're spending money at this point, and then find out that something has happened that no longer qualifies you for that property.
Mm-hmm. So one of the things you have on here is you should not close out any credit card accounts. Why is that? Because it seems logical that if I close the account, I'm going to increase my credit, but that's not the way it goes.
Most people don't realize when you close an account, it can temporarily drop your score. It can decrease your score, particularly as it pertains to installment loans. I encourage people, a lot of times, especially if they're close to paying off an account or whatever. And a lot of times they'll say, well, I can just go ahead and pay that off. I'm like, nope, don't do it. I said, number one, depending on if it's an installment loan, let's say an automobile loan or just an unsecured line of credit, loan that you've gotten from a bank or something like that. If there's only a few payments left on it, and depending on the amount of the minimum monthly payment, we may now have to include it in your debt to income ratio anyway. But what happens is when you pay off that installment loan and that account closes, it can temporarily drop your score. And if you're kind of on the threshold, kind of teetering between being in a good position and being in a not so good position, you don't want anything negative to impact the overall evaluation, because your credit score, number one, it's an indicator, and it has a definite impact on the approvability of your financing. It also affects the type of interest rates that you have to pay. And so you want to have that you want to make as strong of a presentation as you can. And so, yes, when you close accounts, even revolving accounts, because you no longer, even though your utilization may have been low, let's say, you had $10 on it or whatever, you still had that utilization. And when the account closes, that goes away.
Okay. Interesting. So there's a lot of people now that's getting, or they were getting, I don't know if they still have it now, this pandemic relief. So they're making more money being unemployed than they were when they were employed. So they're like, okay, my bank account is growing. Now I'm ready to buy a house. What advice would you give them?
Well, number one, you have to have gone back to work. We cannot approve you for financing on temporary income. And so you have to have, yes, it's always a good thing to save money. I encourage that, especially with first-time home buyers, even though we may have assistance programs that will help you with your down payment and closing costs. Having cash reserves after closing is always an added plus. We call it in the industry a compensating factor. Sometimes, like I said, if there are other weaknesses in a file, that can oftentimes help us to make it over the hump if we're having a little bit of issue getting you approved for the amount that you want. But you have to have full-time employment. We're gonna, require a pay stub, a full 2 years employment history. Is ideal in most situations. Understand, we understand that life situations do happen, and sometimes, you may have gaps in employment, or you may change jobs and things like that. Any employment gaps that are 30 days or longer, they have to be explained and documented in writing, and we have to go back even further. So we don't encourage, it's not recommended. Let me say that. It's not recommended that you have extended gaps in employment. And when I say extended gaps in employment, I would say time periods of, say, 3 months or more where you're unemployed. Now, I understand things happen. If you take some time off to, to raise a child or whatever, if there's an illness, or just, different things do happen. It just has to be explained and documented, and we just have to go back further. But you can run it, with certain types of financing, you can run into issues if we do not have a full 2-year employment history.
So with the pandemic now, a lot of people are off work for 6 months. Once
Mhm.
they start back,
Once they start back and they've received their first paycheck, then we can move. And if there's been prior employment history prior to that, then, and we can verify that in writing, then oftentimes we can move on. If for some reason we're not able to verify that, then yes, that can present an issue.
so as a rough estimate, how much money would a person need to have saved up to before they start the home buying process? Let's say they're be qualified for a $200,000 home.
I always recommend, Vanda, and this is, taking into consideration the different types of financing, conventional financing sometimes has a minimum required down payment of at least 3 to 5%, sometimes a little bit more. FHA is 3.5%. And of course, if you're a veteran, then there's zero down, but there's always going to be closing costs, prepaids for real estate property taxes and insurance and things like that. So as a rule of thumb, what I normally advise people is that you can expect your total out of pocket, down payment, closing costs, prepaids, it can range anywhere from 8 to 10% of the amount that you're looking to purchase. So if you're looking at 200,000, then 8% of that is what, 16,000? But, and I know it sounds like, oh, that's a lot of money. Well, if you got a 5% down payment, okay, that's, what, $10,000 right there. So yeah, I mean, it can very well be anywhere from 8 to 10% if you are purchasing a home that is in an area that has higher tax rates. If it's an existing home, it can be an issue. And so yes, you need to, now of course, there's some ways that we can, try to, structure your contract so that you're not having to just absorb all of that. But as you know, right now we're in a seller's market.
Yeah.
And so our sellers paying, a lot of closing costs and some are and some aren't. And so, you have to be prepared if you're not able to negotiate. If you don't qualify for any type of down payment assistance, all of that has to come from you.
hmm And there are ways that you can talk about. For a lot of times people have money and don't realize they have money in their 401ks. They
Yeah,
have
absolutely. Right.
life insurance
Exactly.
policy that they can get out, and it's written in there that they can get certain amount of money out to purchase a home, and
Sure.
then you're paying yourself back.
Absolutely. And right. And when they do that, people that have 401k retirement plans that will allow for pre-retirement and withdrawals, I realize not all plans will allow for that, but those that do. And since you are paying yourself back, like you said, we don't even have to count that as a debt against you because you're paying yourself back.
hmm Okay, great. So, as a real estate agent, one of the things that we do, of course, we need to know your preferences. We need to know what you're looking for, what your ideal home is. We search the MLS, we send things to you, see if you like it. We show you the home, we negotiate for you. We do a lot of research for you to help you, and we help you try to get the best price. So a house might be listed for 200,000, but maybe the other homes in the area are going for 250, and they just priced it like that because they're trying to get rid of it quick. Well, if we can see that, then we might be able to have the home buyer raise the price. We put in maybe 5,000 more, and then they're giving 5,000 back at closing. So that's
Absolutely.
another way to get some of that
Mm-hmm.
money, of that $16,000.
Mm-hmm. Mm-hmm. Right. But once again, like I said, I keep sounding like a broken record, but choosing the right team. You have to get with the right people that have the experience and the know-how. The people, like I said, you have to be comfortable enough to be open and honest with your real estate agent and let them know, okay, listen, I have this amount of money, but I really and truly don't want to have to, spend all of that. They have to be transparent so
Yeah.
that you will know as their real estate agent how to structure that contract. You have to tell me as your lender, you have to tell me things. You have to feel comfortable speaking with me because there may be something, there's no, I mean, not nothing is 100%. So oftentimes, things that we see when we start the process or whatever, everything may not necessarily be transparent or available to us. All of the information and details may not be available to us at the onset.
Right.
Typically through the process of verification, we find out additional details. So if there's something that could directly impact your ability to get approved for financing, if there's something in your history that you know about, you have to be comfortable enough to share it with your loan officer. That person and your real estate agent, you have to become that has to be your next best friend at least until we get to the closing table. Now, if you want to leave us, put us down after that, then so be it. But we need to be friends. We need to really be close so that you are comfortable enough to share those details with us. Because oftentimes, if you tell us up front, then we can do something about it. But once we get into it and something pops up, then it makes it a struggle. I'm not saying it can't be overcome, but it's critical at that point because you've spent money.
Mm-hmm. And we try, even though you're approved for a certain amount, that doesn't mean you have to go up to that amount.
Right. Absolutely. Yes.
You may want to take a vacation next year or
Exactly.
do something else, and you don't want to be house poor.
Right.
So
right.
I try not to, let people get everything at their max just because that's what they're approved for.
Exactly.
So let's see. So after the home is found, and let's say the offer is accepted, and we do have to submit the pre-approval letter with offers because sellers are not going to take their home off the market just because you got an application, an offer in, and they have not verified that you can even afford this home. They're not going to take it off the market for that. So you have to submit a letter in, and if you're a good agent, you do call the lender on the letter to verify that this letter came from them too.
Yes, they do. And they do.
A lot of fraud out there, and people can just generate a letter online now and say I'm approved, that it's not worth anything.
Right.
So you get calls from agents all the time too?
All the time. They'll send questionnaires, and of course, we're kind of limited as to what information we can disclose to third parties. But yes, ma'am, by all means, they have different ways, and it's kind of funny sometimes to me because it's like, they try to come up with creative ways to get you to disclose different information. But I mean, there are ways, once again, if you experience, you can kind of get a message through without being specific, but you just have to know, how to do it.
I just call and ask, hey, I got this pre-approval. I just want to verify that it came.
Right. But a lot of times what they'll do is they'll ask things, they want specifics about credit scores and things like that. And of course, we can't tell, we can't share with somebody what somebody's credit score is. But, I usually use the point of reference. If you are familiar with credit scores and how they are graded, you have poor, good, very good, and excellent. And so I kind of use that as a gauge, and I kind of say, classify it that way. So, and then it's up to them to figure out what I mean when I say, oh yeah, it's good, or it's great, or it's whatever. You know what I mean?
So I know credit score plays a big part in them getting approved, but I have heard of people with low credit scores getting approved for a loan.
Mm-hmm. It's happening. It happens every day. Well, with FHA financing in particular, you have to realize FHA loans, you can get approved for an FHA loan with a middle credit score as low as 580. Okay. It all depends on the characteristics of the file. Things like debt to income ratios, employment history, and assets. Cash available to close. But yes, ma'am, it is very possible to get approved for an FHA loan with 580 credit scores. We do it all the time. Now, there may be some additional concessions that, it's going to cost you a little bit more And I'll be very honest with you about that. I mean, a person with a 580 middle score is not going to have the same interest rate as someone with a 780 credit score or a 680 credit score, but we can get you approved.
Mm-hmm. Okay. So what are some of the types of grants and loans that you work with, Karen?
Pretty much all of the local and state down payment assistance programs we use in NRL. You have the Texas State Affordable Housing Corporation, which is the acronym is TSHAC, TSAHC. Most people know it as the teacher program, but it's also for first responders and things like that, veterans, and they just have different criteria, depending on if you are in one of those professions, but it is open to other occupations as well. So it's not just limited to teachers and first responders. You have the Texas Department of Housing and Community Affairs. It is another statewide program. Some of the programs are restricted to first-time home buyers and some are not. Most of them are going to have income and sales price limits. So it kind of depends on your maximum household. Some of them is based on total household income. Some of them is based on just the income of the individual who is going to be on the application. And so sometimes, say, for example, if you have a husband and wife and, one person has stronger credit or stronger income, or for whatever reason, they're doing the application under just one of the partners without the other, then sometimes it's just based on just that income. And of course, whatever the applicable sales price limit is based on the area. You have the City of Houston Homebuyer Assistance Program, which is offering assistance up to $30,000. But as you can imagine, with that amount of assistance, there are some stipulations that go along with it. And you have to actually submit an application through the City of Houston. There is a process that you have to go through in order to have your income evaluated to determine if you are eligible for participation, and you have to go through and complete that process before you actually sign a contract to purchase. And that process can be quite lengthy. I mean, right now, it's running about 90 to 120 days. So that's 90 to 120 days before you're able to even start your property search. And so it's not a good fit for everyone, but it is working for some people, quite a few people. As a matter of fact, I would say in the last maybe 6 months or so, I'm sure I've closed at least maybe 7 to 10 deals using the City of Houston program. It is a great program if you have the patience for it, if you have the time to go through it. But of course, as I said, they have sales price and sales and income limitations. So once again, you just check with your lender, when you start the process. That should be, if they are participating with any of these great programs, that should be one of the benefits. That should be an automatic. That should be something that they're automatically looking at to see if you are eligible and if you can, if so, it's a great benefit to you.
Yeah, if you are willing to wait 6 months or so.
If you can. It's not for it's not for everybody, but I mean $30,000. And actually they have special programs that they, are offered on a limited basis for certain like affordable special projects or whatever, where people have gotten assistance considerably more. And so it's worth it. I mean, it's worth it, but it is a process.
Okay. So we submit this offer, we found a great home, and now what happens?
Well, once your offer has been accepted, the first thing you're going to do is you're going to send a copy of that fully executed contract to your loan officer. What your loan officer should be doing, immediately is revisiting your file, making certain that if we do not have the most current or most recent information as it pertains to pay stubs, bank statements, and those sorts of things. The first thing they're going to do is, get a checklist out to you and say, okay, these are the updates that I need for your file. And then, of course, we start, the review of the contract. I do a complete review of my contracts. I look at the real estate property taxes. I look at things like title, who's entitled and how long they've been entitled, because certain types of financing have rules as it pertains to what we call in the industry property flipping. So if they've owned that property for less than, say, 6 months, there may be some additional restrictions that will come into play, and so I look at things like that. We're going to do the data entry and set everything up as far as, the actual sales price, because of course, we've given you an estimate in your qualification, but I mean, those are just estimates. So we need to, look at the actual real estate property taxes that are associated with that property, the actual sales price, review the contract to make certain to, determine if the seller has agreed to pay any of your closing costs or what they have agreed to pay per your contract. And of course, all of that information has to be updated and entered correctly in your file. The contacts, we have to have one of the big things, and I love working with my real estate partners because they are so good about this. But not everybody does. Not all real estate agents are created equal either. But we have to have the full contact information for the real estate agents that are involved, for both on the listing side, representing the seller, and the buyer's agent. We have to have their names, email addresses, their company addresses, and license numbers. All of that information has to be entered into the file before we can move forward to the next step. And so if there are things that are missing from the contract, then, number one, I do try to reach out and say, okay, I've reviewed this, we're going to need this. I mean, it's not something that has to be taken care of like right away, but, I don't like getting into the process and then having to go back and fill in things that should have been addressed. It just makes for a cleaner file. It's always a goal of mine to try to get a file through underwriting with as few conditions as possible. And that's the only way that you're going to do it. You have to be diligent in review. You have to review, sometimes I review things, I mean, multiple times. I'm looking at the same information just to make sure that we haven't missed anything.
Yeah, we're going to get into underwriting on the next one, but
yes, ma'am.
Once that application or offer has been accepted, has been sent to you, then what I do is have the buyer to get an inspection. We're going to make sure that they know what's behind the walls, that the water is strong, the air conditioner is working, and things like that they may not have checked. So you can hire an inspector of your choice, or I can give you recommendations, and that's usually done within the first 2 to 3 days. And then one of the things that your lender is going to require is an appraisal. An appraisal is also paid for, usually up front, like an inspection is paid for up front. So these are some of the upfront money that you will need. Money for inspection, and then your option money, which is usually 1% of the offer price. And so your appraisal is done. They determine if the house is worth what you're paying for it.
Mm-hmm.
And if it's not, I've had instances where it didn't appraise to what it was selling for, and we had to reduce the amount down. So it's good for the buyer, bad for the seller, but it happens.
Right. And then sometimes too, there are those rare occasions, and I say rare, but right now we're in a seller's market once again. And so we do occasionally have situations where a house may not appraise, but, yet, a buyer, for whatever reason, they really want that property and they're actually willing to pay above market,
Yeah, yeah,
for that property. I mean, it's rare. It doesn't happen all the time, but it does happen.
yeah, yeah.
And so in situations like that, we have to go back and reevaluate because, of course, from a lending side, we're going to lend based on appraised value or a sales price, the lesser of the two. So if you do decide to pay above market price for that, that comes directly out of the buyer's pocket.
Okay, so now we're in underwriting. Tell me what an underwriter does.
Okay. They do a lot of things. They make our lives interesting. Basically what an underwriter is going to do, the underwriter is kind of like, okay, they're the final set of eyes that are going to get to look at your file. You have your loan officer who is on the front line. And then once the house is under contract, once you're under contract and we actually move forward with processing, you have the loan processor who is like the second set of eyes that's going to review what the loan officer has already done. Sometimes they'll pick up things that we may have missed or whatever, but basically what the loan processor has to do, they have to verify, okay, the loan officer has already assembled the file. We've included all of the documentation, the pay stubs, the bank statements, the W-2s, the tax returns. So the processor has to validate sometimes the tax returns. So they have to send information or requests to the IRS in order to do that. They have to verify your employment history. So sometimes they have to do certain things. A lot of the employers, especially now, are doing what we call automated verifications, where they're using resources like the work number, where we submit a request through the work number. The employer reports that information to the work number, so we're able to actually verify your employment history through the work number. A lot of companies have gone over to that, but there are some smaller companies that are not actually using that system or signed up to use that system. So in that case, what the processor has to do is they may have to send a direct written verification to your employer in order to verify, your employment history, that you do actually work there, the dates that you've worked there, because as I said before, that's important. We have to make certain that we have documented a full 2-year history. They're going to evaluate, once again, your banking information. If they have to go back again and review those bank statements, make certain that there aren't any unsourced, unexplained large deposits to the account that we would need to otherwise document. If there are other people's names that are on the accounts, or if they're POD accounts, which is a pay on demand account, sometimes we have to get letters from people that say, okay, this person has access to this account, 100% access to this account, this represents. So there's a lot of different things that the loan officer and the processor kind of work hand in hand to document. And then once all of that's done, then it's passed on to the underwriter. Okay. And then of course, what the underwriter is, their primary responsibility is to make certain that, number one, the automated underwriting decision that we have on this file is valid. Number two, they have to make certain that everything is properly documented and addressed based on investor guidelines. And when I say investor guidelines, not just the person or the entity that is going to be buying the loan or guaranteeing the loan on the secondary market. According to FHA, VA, and conventional guidelines, they all have standardized guidelines that say, okay, I call it a bunch of if and then statements. If we have this situation, then we have to have this documentation. And so that's what the underwriter's primary responsibility is to make certain that all lender requirements based on the type of financing have been met. And so during the course of that is where they review and they say, okay, this approval is valid, subject to, you're obtaining this, this, and that. If there's something that they want additional explanation or clarification or documentation, those are going to be your file conditions. That means that the processor, the loan officer, has to get together, get back sometimes with the buyers. Sometimes we have to go to the title companies. Sometimes we have to go back to the appraisers. It just depends on what the conditions are.
Wow.
But we have to satisfy all of those conditions before we can get final approval, or what we call CTC, which is clear to close. Those are the three, that's the love language for the mortgage industry. It's not I love you, it's clear to close. So that's what we're striving for. And so sometimes through the course between underwriting, that initial underwrite, and the final review, things can get a little interesting. But in most cases, like I said, if the loan officer has done their due diligence up front, if the processor does what they're supposed to do, oftentimes we can, get a pretty clean file. And so it's just a matter of dotting the rest of the I's and crossing the remainder of the T's in order to get you to the finish line.
So the time period now, has that been extended? Like it used to be 30 days and 45 days.
Well, it is still possible to get a deal closed in 30 days. What we're experiencing right now, because of the volume of loans that we're getting for refinance, obviously, interest rates have fallen. So there's a lot of people that are refinancing their mortgages down to a lower interest rate.
Yeah.
And so between that and the increased purchased volume that we're experiencing, things are taking a little bit longer. It's taking us a little bit, whereas we were pre-COVID, we were getting completed appraisal reports within 5 to 7 business days. What we're experiencing right now is it's about 10 to 14 business days, sometimes even longer. I had a situation just a week or so ago where we had ordered an appraisal. The appraiser had provided a due date, and we were actually 7 days past that due date getting the report.
Wow.
That's not normal, but it does happen. And usually, based on my experience, when that does happen, it's because there may be an issue with value. Because what the appraiser does, obviously, when they get the order for the appraisal report, the first thing that they do is they have to research market data of recent sales to kind of see what's going on in that neighborhood. Okay. And then once they assemble that data, then that's, they schedule a time to go out and do an actual visual inspection of the property. And basically what they're doing is they are comparing the condition of that property. They're just making a visual inspection of the condition of that property as it pertains to similar sales or comparable sales in the area. And then they're giving us a report. And so sometimes if they're struggling to reach a sales price or something like that, then yes, it can take a little bit longer. That's not normal, but it does happen.
Okay. So I know now that my next one, I'm gonna put 45 days for closing on there.
I think because I know as a loan officer, that's one of the things that that's really one of my pet peeves. I really hate having to extend contracts. It happens.
Yeah.
And it happens quite often. I mean, sometimes some things are beyond our control.
We can always close before 45 days, but just so we're not rushed.
Just so that we're not rushing and we're not having to extend, because no one likes extensions. And definitely you don't want to have to do more than one, but it happens. And so, 45 days, I would say right now would be good if you're able to get it. But I mean, sometimes, and I mean, you probably know that if you're up against, if you have competing offers, and somebody is saying 30 days, I mean, most of the time, you're trying to get that that contract. So
That's true. 45 days, they'll say, nope, not this one. We're gonna go with
you
this
see what I mean? I mean, we can take 45 days, but we got to get the we got to get the offer. So, that can be kind of a slippery slope.
one. Yeah. Okay, so we got everything done through underwriting. Everything is ready. Now we're ready to close, and we do that here in Texas at a title company. So this
Yes.
is where you go and sign all of your loan documents. Now, let me ask you this. Do you send your loan documents out prior to them seeing them at the title company? Is that possible? So they can,
What they are doing now is what they call hybrid closings, and I don't think it's not available just like statewide or whatever, but this is something I think it's kind of a preview to, I think, what's gonna be coming down the pipeline, where at some point they're going to try to make it where you can actually do a full digital closing. What they're making available is where you can actually sign some of your documents prior to reaching the title company.
okay.
Um, Obviously, I mean, I don't know. I mean, I'm from a legal standpoint, they're still exploring a lot of different things because, of course, because of the way, just like recordings and things like that. I mean, a lot of that now is done digitally. The title companies, they're kind of just transmitting documents electronically, and they're doing, the electronic recordings and things like that. So, yeah, but to answer your question, yes, they do send, obviously, the closing disclosure, which is the final, that's the final estimate of, or that's the final summary or analysis of the entire purchase transaction. It tells, details, the sales price, all of the fees that are associated with that purchase, what the seller is paying, what the buyer is paying, and it gives that buyer a final cash to close amount. And so, yes, that is delivered to them prior to closing so that they can review that. And if they have questions, specific questions that they need to ask, their loan officer, prior to close, then they can. But yes, to answer your question, they are providing certain documents prior to closing.
Okay. And they're supposed to do that at least 3 days before.
Well, now that's the preliminary closing disclosure. So that closing disclosure, the buyer actually gets to see that several times through the process. Okay. The first time that they're going to see it, it's going to be in the form of a loan estimate. When you sign your initial contract, and we have an actual loan at that point. We have that's the seventh piece of information that we have to have that triggers the rules that say, we have to do certain things within 3 business days and all of that as far as disclosure and things like that. And so, yes, you're going to have the loan estimate, which, yes, it's going to have a lot of variables in it, because at that point, typically, we don't know, we haven't verified anything. We haven't verified taxes. The buyer hasn't selected insurance and all of that. The preliminary closing disclosure that is required under TRID, which says that we have to deliver within 3 business days prior to closing a preliminary closing disclosure to the buyer for review that, once again, kind of shows them what we estimate their actual cash to close to be. Now, it's not the final number. It's not finalized, because typically at that point, it has not been balanced with the title company. So the title company fees or whatever that we reflect are just kind of like estimates based on what's normal for that price point and that loan amount. So the second time that they receive the closing disclosure, which is the final time, which is right before closing, that is the actual final number that has been balanced between the lender's closer and the title company.
So what exactly does the title company do?
The title company, their part in this entire process is they're making certain for the lender and the buyer that, number one, the lender's lien, in other words, is going to be valid. Okay, they're going to do a title search to determine who legally owns that property and to make certain that the seller of our contract has the legal authority to do that, and that there aren't any clouds on the title, or no one's gonna knock on the buyer's door 6 months from now and say, hey, this is my property, you need to get out. And that's what a title insurance policy does. It gives that buyer and that lender insurance that that's not going to happen.
So they're really an insurance company.
Absolutely. That's why they call it a title insurance policy.
Okay. And they're the ones who prepare the closing documents, and you either go there and sign them, or they can do a mobile notary. They can come out to your house with those documents and do this. And they were doing that even pre-COVID.
Yes.
And they submit those to the courts and file everything and make it legal.
Absolutely.
Okay. Let's see. What you need to bring to closing is a valid form, a driver's license, photo ID, passport, cashier's check, or wire the settlement agent. We don't recommend wiring because there's a lot of wiring fraud going on. So
there is. Some people, for different reasons, like if they are dealing with a bank that is not convenient for them to get to, I've seen some people in those instances that will use wires, but most people, are still doing cashier's checks.
That's the safest way.
Right.
If you're out of the country or out of the state and can't get it there,
Right.
So some of the common closing costs. Now, this can be shocking to a lot of people. You want to talk about some of those?
Well, you have your every piece of the process, for every part that has to be, all the work that has to be performed, there are fees that are associated with that process. Okay, as you've mentioned, or as we mentioned earlier, okay, there's certain part of it that the lender has to do. There's a certain part of the process that the title company has to perform. And so between, the title company, the lender, there are fees associated with when putting this all together. The title company is responsible for performing the title search, addressing any issues that may come about as a result of that commitment, curing any deficiencies. Sometimes there may be easement issues. I've even seen those in rare instances where, you may have, what do they call it? Encroachments and things like that on the property. I mean, it can get involved in detail. And so they charge fees for, their title, insurance costs. They charge recording fees. They have legal counsel, the same way as the lender has legal counsel that assists them in situations where they may need a legal opinion. Oftentimes we're preparing legal documents here. I mean, what we're doing is the documents that the buyer is signing at closing are legal documents that are, it's a legal conveyance of property, real estate property. So it has to be done correctly. And so, yes, there are attorneys involved. They're charging fees for what they do. And so, yes, every part of the process, the lender, we have processors, we have closers, everything that we do in connection with this, processing, completing this file, there are costs associated with it. So yes, but I mean, that's what the loan estimate is for, is to kind of detail those charges and what you can expect to pay. Of course, there's, real estate property taxes that we have to collect at closing. There's prepaid interest. In most cases, when you close on your home, the interest is going to be collected. You say, for example, if you close, say mid-November, in most cases, your first payment on that mortgage is not going to be due until January. And so we have to collect the interest that is going to be due from the date that you close to the end of that month. Because when you make your first payment, in most cases, interest is paid in arrears. So you're paying the interest that was due for that month before when you didn't have a payment. And so, there's prepaid interest, private mortgage insurance, mortgage insurance premiums that have to be collected, property taxes. We have to make certain, even though that buyer is not, they relatively not making a payment immediately, but we have to make certain when it's time to pay those real estate taxes that we have enough money in the escrow account to pay those things. And so there are collections that we have to do for that. There's prorations, because obviously when someone buys real estate in Texas or any place that I know of, I mean, the buyer is responsible from the day that they close to the end of that year, but the real estate property taxes from the beginning of the year to the day of closing has to be prorated from the seller. So all of that has to be broken down and spelled out in the form of a closing disclosure. And on the closing disclosure, that is what it's going to include are your closing costs and a breakdown of all of those charges.
Okay. So speaking of costs, some of the things that are going to be included in your monthly mortgage payment is your principal. That's the amount that you got your loan for, plus the interest. That's the charge to use the money. And then the taxes, as Karen mentioned, those are usually paid in your escrow so that the money is available when it comes time to pay the county's assessor. And then your homeowner's insurance. And we call that PITI, principal, interest, taxes, and insurance. And then other charges that could apply are the private mortgage insurance, FHA, MIP mortgage. What's that stand for? Mortgage insurance.
Mortgage insurance premium.
Right. If you have a VA, you may have a funding fee or a USDA guarantee fee could also be included in your monthly mortgage payment, depending on the type of loan you have.
Right.
So now you're at the finish line. We're there. We signed everything. And now we're getting funding by the lender. So usually when you're at title and you signed everything, they make you wait an hour, half an hour, or something like that. Say they're waiting on funding. So
and it really doesn't take that long. I get so irritated sometimes because, once again, I mean, and I know it's not the buyer's fault, but usually by the time we get to this point in the process, you have kind of developed a relationship with that buyer, and you've worked hard to try to make things as smooth for them as possible. But then you get down to the very end, and then things kind of get, sometimes they can get a little sticky. Now, sometimes I've seen it happen where, everything goes really smooth, and they get everything to the lender, because there's certain documents in order for them to be able to get funding authorization. Part of what the title company has to do is all of the stack of documents that the buyers get to sign at closing, they have to send certain things to the lender for review. And then once the lender reviews that, then they will give them funding authorization. And what that means is, okay, the money that we've sent to you to fund this loan, you're authorized to disperse those funds. And when they say disperse funds, that means, the seller, you can pay the seller his money. You can, you're gonna, the compensation schedules that have been provided for the real estate agents, you're able to disperse those monies. So, and then it's at that point when legal ownership of the property actually transfers. I mean, it's actually, the buyer is able to actually get their keys. So everybody's looking towards funding. And the process is really not designed to be that complicated. We provide a funding document checklist to the title company and it's included with all of the other legal documents that are sent to them for signature. It's all done electronically. And so they have a checklist of items that they're going to have to send to us in order to get that funding authorization. And what happens sometimes is that, especially at the end of the month, things are really busy. And so oftentimes, sometimes the title companies are not able to send everything just right away.
Mhm.
And so it can, it can create, some anxiousness and anxiety for the buyer, because the buyer, and oftentimes the buyer's agent is stuck there at the title company waiting on them just to kind of complete this final step.
Yeah.
And so, but actually in all, probability, the funding process shouldn't take any longer than 30 to 45 minutes. If it goes on any longer than that, somebody's just not doing what they're supposed to do in a timely manner. But 30 minutes tops, and it can actually be done. What I suggest sometimes, and of course you can't tell people how to operate their business or do their business, but if the title company has the time to pull out the funding documents first and have the buyer to sign those documents first, then somebody else can be sending those documents over to the lender while they're finishing up signing. And then once you get to the, once you've completed, then you've got your funding authorization, and boom, everything, you're able to get on, going on your merry way. Everything's done.
I'm going to
But that doesn't always happen.
on my next closing. I am going to suggest that, because my last one, we didn't get confirmation until 8 o'clock at night. We were there.
That's ridiculous. That is ridiculous. Vanda, it's not, it doesn't have to be that way.
She got her keys at 8 o'clock at night. It was like,
does not have to be that way.
They're like, you're not going to get it tonight. It's not going to be till tomorrow.
See, exactly. And that's only because it kind of, especially, and I can understand, trust me, I get it, because when you have, 40, these title companies, sometimes, especially the ones that close for builders, new construction, that they may be closing 40, 50 deals that day. I get it. It's hectic. It's a lot, but it's your job. So, I don't know, but we're going to leave that. But yes, always ask them to pull the funding documents and have those signed first.
I will do that. Thank you. So that way we can get those keys and celebrate and be gone.
And go on about your merry way. Yes. Yeah.
So we're at the end. We did all 10 steps. So the title company will confirm the recording after that, and you're on your way. So you move in, and congratulations.
Right. I enjoyed it, ladies.
Oh, thank you, Yolanda. Thank you.
Yes, I'm sorry. So much noise in the background. My son and grandchildren showed up. So I just wanted to let you know that I really did enjoy the steps.
Thank you for joining us.
Mm-hmm.
I'm going to stop the recording.